Good morning, everybody. Welcome to Monday. Back from our holidays. Good morning, Kay.
Good morning, Ryan. Welcome back, mate. Hope everything is okay.
Yeah, very well, thank you, mate. And want to start off with a big thanks to you and the rest of the team, the other guys, for taking over the Flow Show in my absence or filling in while I was away. I hope it wasn't too stressful for you having Stephen still on board.
No, we had some Greek fun. We had a heat wave. Still, I felt a bit Greek as well. So no, it was all okay, man.
All good, all good. I'm sure they kept you, all the viewers, well entertained. Yeah, so I've obviously been off for the best part of 2 weeks, so I'm a bit behind everything. I was actually been out camping for the last 2 weeks, so I've really been out of markets. I hardly looked at my phone, didn't really know what's going on, so I'm playing a bit of catch up this week or today at least. But I like to do that. If I go on holiday, I do like to switch off everything, because there's no point in going on holiday if you're going to have your nose in the charts and in the news all day, every day. I like to give my brain a good old refresh. So I'm ripping and rearing to go this week. So we'll get straight into it. Start off with some of the more recent stuff from Friday and over the weekend, data and stuff that we've had out. Going to start, as we often do, in China. So just some of the headlines. There was a headline out not so long ago, about 10 minutes ago, saying that if I get this right, the Sichuan province has been asking industrial firms, or is asking industrial firms, to shut down between today and the 20th of August to preserve power supplies for residential areas. So this, I don't know a bit of the context to this, but that is obviously going to be a little bit of a hit to activity in that area. I'm not sure if this is widespread, and maybe Kay can fill me in on that a bit in a moment. Now, looking at the data that we've had overnight, and a lot of the market is really sensing bad news from China. Now, the first thing on there you can see is we had house prices dropping 0.9% in July year on year. Then we've had some of the other numbers, retail sales, investments, industrial production. And if we go through them, just taking a quick overview, it doesn't, there's no real massive negative numbers here. There are misses of expectations and drops versus the prior month, but they're still all positive numbers. Look at industrial production. Okay, it missed the 4.6 expected, but it only dropped a pip on last month. Year to date, it was higher. Retail sales year on year, again, miss of expectations, lower than the prior reading, but still a positive number. Unemployment rate even better. So there's a lot in the market are seem to be making a big deal with this, China slowing, that sort of thing. And that's true in one sense, but, we're not talking about an overall collapse. We're not talking about anything going into minus numbers, and some of these numbers dropping negatively. And I think it makes it bad, but not as bad as perhaps the market might jump on board on. Now, obviously, we also, in amongst all that, got a couple of rate cuts in China. The main one being the PBOC cutting the MLF rate, which is the medium term lending or loan facility. They cut that by 10 pips to 2.75. I'm not sure why this calendar has 3.7 as a prior. It's actually 2.85 as the prior. It also cut the 7-day reverse repo rate to 2% versus 2.1%. So another 10 pip cut there. So adding it all together, the market's seeing softer data, rate cuts, and it's obviously putting 2 and 2 together right now as we sit here today. Now, what I would look for, and what we haven't seen for a while, is the reserve requirement ratio cuts. These are the big ones, and we haven't seen those for quite some time. This is the amount of money that banks have to set aside as a buffer, if you like. And if China really wants to inject some monetary stimulus, that's the rate that they would cut to allow that money to then move into things like loans and into the economy, almost like QE, if you like. It allows money to flow through into the economy. But China seems to be steering well away from doing those cuts. So when you look at these short-term rate cuts on the loan facilities, it really is a bit piecemeal. Now, does seem to be a bit of a problem in China with lending stalling. And looking through some of the news articles around the rate cuts last night, it looks like people are actually choosing to pay off loans and save money rather than borrow more. Now, that could lead to a slowdown in the economy, because if people are putting money towards savings and paying off loans rather than spending, then you're going to get an actual drop in activity. You could be heading for recessions and that sort of thing. But it's important to know the difference between the types of slowdown. A slowdown in an economy where consumers are feeling the pinch, such as like people are facing in the US, in Europe, the UK, particularly higher energy costs. So if money's being put from income into paying higher costs, paying higher energy bills, that can dampen activity because there's no spare money to spend on other items. Things like holidays and non-essentials tend to drop. That's a different kind of slowdown. That's an economic pinch or a financial pinch on consumers that creates a slowdown. When you've got people who have money but choose to put that money into savings or paying off loans, it's almost planning for a rainy day, so that they're not feeling a pinch. They've got enough money to get by, but they want to put that money aside because they fear there's problems coming. That's a different kind of economic slowdown. That means that money will be sitting there ready to come back in if things improve. And it's important to make that distinction when you're talking about economies and whether they're good or bad, or one type of recession versus another. So in China, people putting money towards paying off loans, and particularly in the housing market, we heard before I went away that some people are even refusing to pay loans on property loans because the properties weren't being built, and they're paying money for new properties that are not getting built. So that type of activity may be negative for China, and the markets and everything will just see weaker data, recession fears. But for us, it's important to know what type of recession that might be, or what type of negative economy that might be, because there is a big difference between them. Now, just to finish off the US-China news, we have still got this bubbling stuff going on with Taiwan. I know there's been some drills run by China. Now we've got a delegation from the US going to Taiwan as well. So this one keeps simmering, and I'll let K-Man come in and on that one and just give a bit of an update, to me at least, on what's been happening there, because it does seem like those tensions continue to simmer on that side of thing. So Kay, what do you make of the China situation? Is the market getting a little bit over negative on the data, or is it purely justified?
Well, I think it's twofold. The market, first of all, in the Chinese situation, it's not so much the fact of China massively slowing down, but it's the accumulation of a slowdown, and then the virus kicking in more and more. They also seemingly discovered some new virus, which is really it's not meaning much, but I think the market got a little bit of a shock opening this Monday, especially that on the other side, we have seen a lot of carry trades being put on last week. Market, because of the US data, because of the data elsewhere not being as bad as one may have feared. We had like stronger labor report. Of course, the CPI data came back a little bit, but one number is probably not going to completely change it. But on this China situation, yes, we have the Taiwan tension. The market did not really trade a lot of it until now, but I think now we're seeing the accumulation of the surprise rate cut by China. So we might expect, I think, the 5-year and perhaps the reserve requirements may follow. they usually don't do everything in one go. So we may, in the next couple of sessions, see the longer term being cut as well. So I think it's all about the a wake up call and a bit of stress over the carry trades being put on last week. Everything was going well in the commodity sphere as well, and now we are seeing like pretty big setbacks this morning, like copper trading down 3%. Silver, gold shying away from important levels. It's all an accumulation and everything coming together. And I also think a bit of lack of liquidity being the month of August, and come on a Monday morning, all of a sudden we are running. What it seems to me, we're running a little bit from stopping to stop. The short term is getting a bit washed out again. Now, if you look at dollar China, it was like relatively quiet after the dollar setback, was relatively quiet, and then overnight it really jumped in a good old fashioned, nearly 1% higher on the accumulation of everything. So it's more like a bit of people going into the end of last week on long carry trades, and especially the antipodians. It was very popular to sell yen versus antipodians, sell yen versus and euro versus the antipodians. I myself, I'm a little involved in those as well. But yeah, I think it's the Monday morning scary wake up call that is causing all this reaction. I think we'll have to see a bit deeper into the week if those scares are justified or not.
Yeah, definitely. You know, I'm assuming also we're right in the thick of summer markets as well, and we're seeing, you know, hours go by where nothing happens. Then you get these little injections via a headline or something, and we get a move and it all quietens down a bit. Are we seeing a bit of that?
Yeah, the market. I think went into the weekend, as I said, the euro Aussie on its lows, sterling Aussie on its lows, the yen pairs relatively higher again, and the dollar already doing better overall. But then the antipodians especially have been hit by the China news together with the CNH, and I think it's just a lot of it is positioning and position unwinding, few short-term stops. So we have to see how it goes for the rest of the week. But yeah, definitely when China slows down a bit, the rest catches a cold. So we have to be a little careful with what's going on right now.
Yeah, and trading wise, I mean, the reason I was trying to make the point about, you know, trying to decipher what type of weakness China may get, you know, if it's not really a weakness due to you know, big fundamental issues, you know, people not spending money because they haven't got money, then that's when I can look at trades and think, well, if the market goes heavily into the negative, for example, Aussie gets sold off heavily because of recession fears, you know, if I think that it's not going to be as bad as the market expects, that's when I start to think, well, maybe I want to try and counter some of these trades. And one of the pairs I was looking at was dollar one. You know, we're right up against the old resistance area, up in that you know, high 678, and I might give it a couple of sessions to see what's going on. But if we can't get above that 680, I might think about just having a little punt short there. Nothing big, because obviously I'm only back first day, so I'm not going to get too stuck into things. It can take me a couple of days to get my fuel for the markets back, but that's the sort of trade you'll be looking at. You know, if Aussie's been grinding higher over the last few sessions before the China stuff hit, you know, and we can see the trend from July. Just taking a quick look at Aussie, it's been moving higher. You know, if you don't feel that the China news justifies this move, then that's something you'll look at, maybe potential for a fade. But as I say, that's something I'll have to look at over the days ahead. Just popping back to the data and the rest of the headlines and stuff. Japan GDP came out pretty good. Some decent numbers there. Obviously, the lockdowns that they had not impacting too much, or the higher COVID cases not impacting too much. So some better numbers there. Looking at the US CPI from last week, it was a miss on one in one aspect. We saw obviously let me find it here, then I know what I'm talking about. Where are we going? 12:30. Where am I going? When was CPI? Was it Friday?
No, it was well before, mate.
Well before. Oh, there we go. No, I'm still missing it. What day was it? I thought I had it up here.
Yeah.
Was it last Wednesday? Yeah, last Wednesday. So obviously we got the drop there, but the in the headline CPI. Now it has been volatile, as we know. So you know, a 6 pip move is you know what would you normally be a 2 pip move in CPI. But for me, the core CPI held up there, and that was key because it still shows that there's underlying inflation coming through. You know, and then into Friday, we got the Michigan numbers as well, and those important inflation expectations, where the longer term 5-year expectations actually rose by a pip to 3%, even though we saw the 1-year inflation expectations dropping 2 pips. For me, this 1 year is almost like a gauge of petrol prices, you know, car fuel prices in the US. It's a very short-term thinking indicator from the US citizen. You know, if things like petrol prices, food, you know, have showed drops, you know, month to month, that impacts these numbers and the short-term thinking about inflation. But the fact that the longer term is still heading higher or is still higher suggests that the US consumer is still thinking that prices are going up. And as Kay said about inflation, you know, one report doesn't make change a trend, so we have to watch out for something like that. But if we look at something like the import price index that was also out on Friday, just to have a quick look at that, we are seeing a bit of a trend of lower prices coming in there. So this is import prices are what firms and businesses are paying for import costs. Now, obviously, some of that can be reflective of the change in the currency. So that's one thing that we also need to look at as well. But generally, we have, you know, from the April data or the May data, we are seeing a drop down, a general trend lower in those numbers. And those will be part of what we need to look at to see whether inflation has peaked or not. Is that really going to feed through? But you've also got two sides. You've got the imported inflation or prices, and then what's happening domestically. So domestically, with that core inflation in the US is still holding up. So I'll be loath to call a peak in inflation just yet. If anything, we could see some sideways movement there. So that's it from the data and the headlines I've seen overnight. I don't know if you've got anything you want to add to that, Kay?
No, not really. The only thing that is still going on is we've seen a bit of a setback on this dollar yen because the commodity price is coming off overnight. But in the bigger scheme of things, if we think central banks and everything, Kishida and the Japanese economy minister now has tasked or has been tasked to come up with concrete numbers and plans to alleviate the pressure on the Japanese consumer, the Japanese companies again. So they are still doing a bit Bank of Japan's work, where we're seeing better growth popping up in Japan, which is mainly due to the reopening. We've come from a negative number and jumping back into positive. Well, actually, the negative number has been revised a little bit better, but we're jumping back into positive territory. Let's see as well if it lasts or not. Those things, because the consumer expenditure it was still very low. But we have seen a better industrial production also due to those reopenings that they had in May, June. But yeah, I think the government is still helping out Bank of Japan in a massive way. So I do think that on the bigger scheme of things, yen may be one of those who remain on the defensive because of the ultra low yields. So that was another piece of the news that I saw over the weekend, but I didn't see that much. Yeah, the German waterways levels are extremely low, so there's a It's very difficult to navigate on the Rhine, for instance, and I reckon it just continues to add on the weight around the euro's neck on a global basis as well.
Yeah, I saw that Germany are upping how they're transporting stuff now, using, you know, obviously road and rail more so, and potentially shutting off public transport to use that capacity for transporting. It's mainly the coal up to the power plants.
Yeah.
So that again is a growing situation. But now we're heading to quite a few storms, I think, coming, or a change in the weather coming across Europe here in the UK. So it could be a fact that we're next going to see floods appearing, because obviously everywhere is drying and the ground is dry. So when you get sudden torrential rain, it's got to run somewhere. It won't go into the ground. So it's going to go from one extreme to another, and that may not necessarily fix the issue, because you could get a big floods and the rivers, you know, obviously building up, and then all of a sudden they dry out again as that moves away. So if people start to look at the weather in Europe as that's going to fix things, that may not be the case in the short term, at least. But let's have a quick look just at some of the data points that we got coming up in the week ahead. We start today with the Empire State Manufacturing, which kicks off all the manufacturing data for the month. We've got the NHAB Housing Market Index, which took an absolute pasting last month. That dropped from 65 to 55, a real big move there. So we need to see if we're going to see further problems in the housing market there. Then the rest of the week, we do get a bit of other housing data from the US, starts and permits, existing sales throughout the week. Can't see any other ones there. Obviously, the German Zoo survey tomorrow, that'll be closely watched to see how bad things are in Germany, how bad firms, investment firms and all sorts are faring there. UK labour market report tomorrow morning. That to keep an eye on for what's happening there, and obviously what thoughts that may play into the Bank of England. RBNZ is coming out on Wednesday, alongside UK CPI. I don't have any expectations for the RBNZ. They're still on the hike path. It's another 50, is it?
Yeah, the market expects 50, and then perhaps starting to build in a pause, or have at least a hint that the bigger hikes are behind. But yeah, that's what the market expects.
Yeah. On Wednesday, we've got Eurozone GDP numbers. You know, we're into August now, or midway through August now, so these things are really pretty much going in the rearview mirror. It's the pan Eurozone number, so we know what all the individual countries are doing already. Retail sales is probably going to be quite important, and maybe business inventories too. Obviously, retail sales for the consumer aspect, to see how the consumer is holding up. Are there going to be further problems? Is spending becoming tighter? Is inflation biting? Keep an eye out for, usually after we look at the headline numbers, and then we get the analysts and propeller heads looking at the real retail sales, because the headline ones are not adjusted for inflation, but people do their calculations looking at the adjusted numbers, and they've been down the last couple of months, I believe, the real retail sales. So keep an eye on those, that part, to see if it's any worse. We could see a positive number from the headline numbers, but once you've factored in all the inflationary stuff, they could be negative again, and that takes a bit of a shine off what the market might see from the headline numbers. FOMC minutes, not usually these days anything worth looking at, because we've heard 1,000 times from each Fed member since the FOMC. Aussie jobs on Thursday, one to keep an eye on there. Eurozone HICP, is that the flash K, or is it the final number from that? I'm not sure. Let's have a look.
Oh, sorry. On the Thursday, I was looking at something else. On the Thursday, you mean? Yeah.
Yeah.
I don't know, to be honest. Let me see. Let me quickly check.
Okay, it's the revision. It's the final number.
Yeah.
Final number. So that would have been out. Yeah, jobless claims as normal. Then we get the Philly Fed manufacturing on Thursday as well, the second number there for the manufacturing month. Then we get a few more retail sales numbers, UK, Canada on Friday to end things off. So a reasonably busy week for the data-wise, planning to hopefully keep markets moving. So now we'll jump into some of the pricing. And as I say, I'm a bit behind on everything because I am still playing a bit of catch-up. But as someone in the room previously mentioned, when we're round about where we were when I left. And there's been a couple of little round trips here and there. Nothing really breakout as far as I can see. Let's get rid of that if I can for the moment. No, it's not having it. So you're looking at euro dollar, we'd been stuck in this sort of high 103, high 102s, low 101s, a little bit of a breakout there. Was that purely data driven, mate, on that one?
As a CPI, PPI, when they came out, euro tested the highs. I've got a bit of a level there as well. I can show whenever you want me to take over the pictures. We lost you?
Yeah, no, I'm here. Yeah, I'll let you take it over, mate. You've probably got more updated stuff than I have.
Okay. So yeah, just to round up what you were looking at, we had this test of the 103.5 last week, and then as I was showing, I've got a 50% retracement as well from the last time we tried to get up to 108 and then all the way down. So that's around 103.70, which clearly failed over there. And now we are back to lower levels. We had a bit of a as you were saying, there was a bit of mismatch between people trying to call peak inflation and then data coming out on the other side, not showing an as bleak a picture of as people were expecting. So we had what I already was saying last week. We had this shakeout in the yields, especially the longer end came back down quite a bit when those CPI data came out, and we dropped below 270 on the 10s, for instance, back into the 260s, and but since then we did see a revival, and that is causing everything to come back sort of within ranges, and causing the dollar to climb back. So I think on the day this 102.10 is the first little point of measurement on the euro dollar. Then we got like 102.40s, but basically it's important on the short term, but I don't think it's important in the big scheme of things whether we close above or below this 102.10. Because we are still in this box, and I think the box is valid until we break back until below 101.2030 really.
It looks a perfect technical top, that, doesn't it? We'd have been looking at that 103.40-60 area for for a couple of weeks.
It is. It is really. It was a really big test and rejection, because we spent a few hours trying. On two separate occasions, we tried to get through it, and then the thing just the ship turned around again, and here we are back well in the middle, but a little bit lower, because end of last week euro also got a knock on the head when this Rhine thing started to be to weigh on German shipments and stuff, and again. The Ukrainian situation doesn't seem to clear up either. And then at the same time, since the rest of the economic data did not really deteriorate much, we had the carry trades coming back, of which I talked a couple of times last week, but which were like really significant, I think, for the course of what's happened then. Let me jump over to the dollar yen. We had this big breakout through through the 134.40 as I was already mentioning last week, and then we came back here. But then I have to go onto the daily and show the cloud again. We tested really the underside of the cloud, which is really important for the Japanese investors, and we held, whether it be investors or Mrs. Watanabe and Sons, they are looking at this. So this is the one that held last week, went a bit low. I went a bit long. I've actually covered the rest this morning because I was a little worried about those commodities and things. And if commodities come off, usually it should have a bit of a strengthening effect on the yen. But for the time being, dollar yen is actually not really reacting to it. So I think top side, we go back to this 134.40, which is important. You can see it here again, and I was saying this whole 134.25 45 zone on different time frames is really of importance here. This zone is really important in my opinion. If we ever make it back there, for the time being, we are respecting this 38.2 of the move lower. We are respecting it, so. Respect it too, I would say. I have as well. I've taken some off up there as well when we tested it. So the 133.80s are already a level where we have to pay a bit of attention if we make it back up there. Then let me move over to the usuals. So for the time being, at least, we failed to break in gold, and we failed to break the 1804.05. We tried above on those weaker CPI data in the US, but then it failed. What is worth noting, though, is that we are, for the time being, holding above this trend line, which comes back from the highs. Back in March, and we, for the time being, are holding above. So this little zone here, 1775, 1780, respect it. We are trading right on the 1780. So I respect it. If it crashes back below, we might see a move back to the 1755, which is a bit of a traffic zone in gold. But for the time being, it's just seems to be trying to consolidate ranges. A bit similar on the silver, as I was showing last week. To me, this 85.21, the figure zone, is important. We are trying breaks. It's fragile still for the time being, especially with the slowing of the numbers in China and the fears about more lockdowns. Since silver is a industrial metal, we have to be a bit careful with silver if we get more weak data. But as people know, I'm still long, and I have been scaling back in the 70s, and I'm waiting whether to buy it here. Last time it would have been a good idea, but I'm rather looking at it for a possible setback even to around 1950, which is still possible. Moving on, as Ryan already showed the picture earlier on this dollar China, it really came back with a vengeance overnight on the triple whammy of lockdowns, PBOC, and a bit weaker data. So we rallied back through 674.5, 75 without even noticing it when we look on the shorter term chart. And we're slowly getting back into the 678.5, 79.5, which is the bigger resistance area. So we went up to 678.5, and now we're shying back just under 678. So keep an eye on that. What we could be in for another bit of a rejection of the level. But with what's going on with PBOC now effectively starting to cut rates, I'll try to buy a setback around 675 there for now. The other one, okay, this is starting to look a little bit messy, but we did try to break, and are we still below? Yeah, we're still below actually. this red line on the euro mix. I'm still short. I'm waiting to see today go by and see where we end up, because if we're below, I think the move down to 20 could be imminent. If we start to get back above 20, I call it 40 and a half, the close, then we may see a little bit more of a retracement, perhaps back into the 2060s, 60s, 2080, perhaps. But I don't think that particular carry is over yet, especially with Banxico having risen another 75 bps last week. Yeah, so the one that I was playing as well, and that I'm still smalls in, is I played this break on the Euro Aussie. As people in the room know, I've been trading it around, buying back, selling back, and now I'm watching with a core short. I will try to sell it on the 145.30 again. I think just for the sake of the level, and then see what happens here. If we get a close above 145.50, 60, I may just step out, take what's left, and wait for a bit. If we in turn hold firmly below, and ideally even go below this one, 144 and a quarter, then I think it's firmly oriented to the downside again for a move down into the 143s. And somebody was showing another pattern on the Euro Aussie in our chat room end of last week, saying that we could be on our way to 141s, but one step at the time. And the last one on crosses I wanted to show today, I've got two actually to show, is this sterling Aussie. We've been consolidating for a while and yo-yoing up and down between this 171.80, 171.70 zone. And last week we broken through it. Today on the commodities drop, and on the and on the China situation, we are trying to get back to it. I may give it a go around here, this 171, just below 172, with a stop not too far away. I think the risk is relatively small, but the potential, if it would cap there, could be relatively big. You're down to 168 for a starter, or maybe lower. But we'll need to confirm closes below those lows, in my opinion. And with this, I'll give it back for Katie, Cadyen. Just close the short and wondering whether to risk a long. Catherine, I'm going to pull it up. I haven't been involved in it, but where is it? Here, I have to update my if you've been short, well done. It's you've probably been short. Have you been short with this trend line? If I may ask, just say yes or no on the chat. Okay, lovely. Well done. Going long, it's possible, but it all will depend on the sentiment. It could be a good case of trying along around here, and then depending on your risk level, you don't have to put the stop far away, either under the low that we saw end of last week, or if you feel a little bit more adventurous, just below 103 the figure. But yeah, it could be something worth paying attention to, especially that we may. I'm not saying that we have overreacted on the Chinese situation, but we may have seen a lot of position unwind of those short-term carry trades, and then once people reassess, they may come back into the frame. So yes, we have. There's a possibility of this bottoming out here. And Ryan, with this, I'm going to give it back to you for today, mate.
Yep, no worries, mate. I just want to share one thing really, or maybe a couple. Let's start here. Dollar Hong Kong finally had a move off the top. For those who've been in the show for a while in the chat room, now I've been short up here, right up into the top of the band. For those that don't know, the HKMA run a currency band between 7.75 and 7.85, and that price has been stuck there, as you can see, forever and ever. So it's been a low risk trade for me, having a short up here that I've been sitting on. It hasn't cost anything to sit on it in terms of carry. So it's been a free ride on that one. I did have a partial TP in at 784.50 just to knock a bit off if it ever dropped through there. That got activated a few days ago, and just a moment ago I've taken some off at 83.57 on that. So we're getting a move away from the band at the moment. Probably in terms of the same thing that why the yuan has moved in China on the rate differentials there, or the cutting rates there. So I'm just keeping an eye on this one to see if we get a move down, hopefully down towards the 680s or the 780s, I should say, at the very least. I've also just scratched an itch in dollar yuan while Kay was talking. I've had a small sell at 678 and change. Got a stop currently at 6.8250. Nothing big. I might add a little tiny bit as we get up there. This is purely just playing against this long-term resistance that we've seen up here. You know, even with a rate cut, we can't break it. Even with bad news, we haven't broken it. So I'm just playing the levels on that one. Just a little feeler trade, perhaps, just to get me back in the swing of things. So nothing big on that one. Just looking around, as I say, I am going to spend most of today going through the charts, just seeing what's going on. Euro sterling is obviously one I want to potentially look to get back into. I cut all my positions before I went away, purely because it was costing me money to sit in it while it did nothing. I'm just going to be looking at perhaps trading the breaks rather than trying to get in. I want to be long. That's my bias for this pair. So if we get anywhere down towards the lower 83s, I'm probably going to start picking it up. Otherwise, I'm not going to be interested unless we start breaking around about the 86s or even some of these highs up here. And then I'll look for a breakout trade. So a couple of movers there, particularly from the Hong Kong dollar last. As I say, I've been sitting that one for a few weeks. Nice to finally bank a few pips on that one. So yeah, a bit of a short show, say, because I've not got much trade on the prices myself. Because I haven't been in at the screen, so I need to get back in the rut, if you like, back on the path. I don't like just coming back in and blasting away with the trades until I really know what's going on and get a feel for the markets, and that can take me a couple of days. So we'll leave that there for today, and obviously, hopefully, have a lot more, particularly for me, to say tomorrow. Once again, thanks to Kay, Steve, Stel, and the other guys for stepping into my shoes while I've been away. I hope they've done you guys proud. Thank you as always for coming to the show, and we shall pick this up again tomorrow. Have a great day all.
Have a good day, everybody.